Every day, financial experts dive into complex market data. Currency pairs, yield curves, and equity futures can overwhelm anyone. However, sometimes all this detail boils down to one crucial number. In 2022, that number was consumer price inflation. One inflation reading forecasted market movements across sectors. When oil prices rise, it influences stock and bond prices. Understanding this link is vital for investors at every level. For decades, stocks and bonds moved as opposites. When stocks fell, bonds surged. This negative correlation built the foundation for a classic 60/40 portfolio. You own 60% stocks and 40% bonds. This combination offered stability during downturns. But in 2022, this relationship broke. Inflation surged. Central banks raised interest rates aggressively. Suddenly, stocks and bonds began to decline simultaneously. The familiar safety net was gone. Research shows this correlation flipped positive, increasing portfolio volatility. A classic 60/40 portfolio now carries heightened risk. The way we understand and manage portfolios must adapt to this significant shift. Why did this happen? Inflation is the key factor. Under low inflation, bond prices rose as stocks fell. Now, inflation dominates the conversation. Investors fear rising prices for both asset classes. High inflation hurts both stocks and bonds. This change reflects a structural shift in financial markets. Understanding this cause is essential for investors looking ahead. Some may wonder about alternatives to the traditional portfolio. Private credit, buffer funds, and even Bitcoin surfaced as possible solutions. Each promises diversification, but do they actually deliver? Research finds these alternatives correlate more closely to stocks than bonds. For instance, Bitcoin's high beta doubles equity risk in portfolios. Thus, they may not provide better diversification than bonds. History offers valuable lessons here. From 1965 to 2000, stock-bond correlations were persistently positive. Investors survived recessions, oil shocks, and financial crises, often relying on bonds to cushion equity losses. The 60/40 portfolio still offered solid returns during that time. Positive correlation doesn't mean bonds will fail. They can still provide vital protection in crises. What should investors do now? Adjust your stock-bond allocation based on your risk tolerance and market conditions. Bonds are still essential, albeit with less protection against equity risk. So how do you balance your portfolio? Risk-averse investors may want more bonds now. Those comfortable with volatility might tilt towards stocks. Understanding the relationship between these assets is crucial. Looking forward, will this market dynamic remain? Many researchers believe the positive correlation is temporary. Economic changes, especially in inflation, will likely shift the landscape again. Stable inflation could restore the historical stock-bond relationship. However, investors must remain cautious. The current geopolitical landscape presents ongoing uncertainties. In summation, the breakdown of the stock-bond negative correlation is real. It prompts valid concerns for portfolio strategies. But don't abandon traditional strategies, calibrate them instead. The 60/40 portfolio remains an accessible choice for most investors. Its advantages, such as income generation and genuine diversification potential, still hold. As you navigate this new market landscape, understand that no single number, even oil prices, dictates market behavior forever. Stay invested, adapt your strategy, and always keep learning. Ready to rethink your investments? Join us as we explore these shifts and make proactive portfolio adjustments today.